Hey guys, welcome back to the channel. My name is Evan and this is Sense or Sense, where we talk about making you some sense or learning about some things that are common sense or give you some good sense of what's going on in the markets. And today I want to talk to you a little bit about what everybody seems to be talking about, which is interest rates and the Federal Reserve. There's a lot of talk out there about the Federal Reserve should lower rates by a half percentage point. There's also, consensus out there that there's going to be a quarter point reduction in September, and then the discussion about whether or not there's going to be additional rate cuts going into the end of the year, especially in December. Obviously, it's an election year, so the Fed is supposed to act in complete, unbiased behavior, and they're not supposed to allow that to influence them, but I assure you there is definitely some influence there with it being an election year. However, I wanted to talk a little bit today about my 20 plus years of being in the industry, what I've seen in the past, as well as what I just saw this morning with regards to economic numbers. So this morning there were a bunch of numbers released, the first of which was the jobs report saying that the jobs are much stronger than they have been in the last couple of months, as far as the number of people maintaining their jobs, the number of people being able to continue to look for jobs has stayed low relative to lots of other patterns in the economy and lots of other times in the economy in similar circumstances. So ultimately the jobs market is holding up better than most people thought, and that's something the Fed's going to definitely be watching. The second thing was import and export pricing. This is something that's gotten a lot more attention in the last several years because of inflation, and ultimately import and export pricing came in at pretty much the highest level in the last more than one calendar year. So the year-over-year numbers were higher than expected. The month-over-month numbers were higher than expected. This tells you that the cost of bringing goods into this country and shipping goods out of this country are still increasing more rapidly than people are anticipating. This is not good for inflation. That just says that the costs of things are not coming down as quickly as we thought they were. This is a major component of what the Federal Reserve looks at with regards to whether or not they're going to lower rates, and it's not coming down as quickly as they thought it was going to. The next thing is that the overall inflation rate, over the last couple of weeks has shown to be pretty resilient. Is it below 3% for the first time in quite some time? Yes, it is. Is it getting closer to that 2%? Very slowly, that the Federal Reserve looks at. They always look at that 2% as being their kind of mandate, what they're required to try to get close to before they really start stepping the gas on the rate cuts. But it's been pretty sticky, and I've said this in a couple of my other videos, that the interest rates out there in the marketplace are coming down on the long bond, so the 10 and 30-year bonds are coming down. But if you look at the shorter dated bonds, the 2 and 5 years, they actually haven't come down anywhere near as much. So that shows you that in the long term, the economy, the markets are pricing in rate cuts, but they're not pricing it in anywhere near as quickly as a lot of people anticipate is going to occur. And that's why I don't think that there's going to be a half-point reduction in interest rates. I'm actually kind of on the fence as to whether or not a quarter point will happen. I think it will, just because of the timing right before the elections. And furthermore, I think that the economic data that's coming out right now still shows that our economy is very strong. Another data point that came out today was consumer spending. And consumer spending is showing, it showed a little bit of weakness the last couple months, but ultimately it's now showing that consumers are continuing to spend. And ultimately, all of these things just show that the Fed needs to be more cautious than what everybody has anticipated. Going back to the end of 2023, people were saying, oh, we get 4, 5, 6 rate cuts. Well, guess what? Here we are in August talking about September, and there's been not a single rate cut, and I think there will be 1, maybe 2 rate cuts before the end of the year, assuming that we don't get any more, crazy data showing that inflation is rearing its ugly head, and or some other data that could spark the market, such as a downturn, such as a war that breaks out in the Middle East, something like that, that's completely out of our control, may cause the need to take on more rate cuts. But right now, things are pretty steady, pretty much in line with where I thought they would be at this time of the year, but they're not coming down fast enough for the Federal Reserve to say, hey, we're going to lower rates significantly over a very short period of time. They're not going to go out and they're not going to lower 50 basis points this next coming meeting, and then another quarter, and then another quarter, and another quarter. My guess would be 25, then they're going to pause, and then they're going to maybe make one more rate cut before the end of the year. And then depending on the elections and what that means for the overall markets and geopolitical stability out there and oil costs and all these other different things that come into play, they're going to watch those much more closely before they do anything more than say a half to 3/4 of a full point, over the next 4 to 6 months. So I wanted to bring you my analysis today. This is my 20 years plus of being in the marketplace. I've seen it, many rate cycles, increasing rate cycles, decreasing rate cycles. I've seen lots of economic data. I actually used to study economic data like this all the time for when I was in the hedge fund industry. So just be cautious. They will come. The rate cuts will come. The long bonds are showing that they're going to come. But be cautious out there. Maybe don't throw everything in the markets right now. The markets are pretty lofty. And ultimately, I think that, this is the time to be a little bit more cautious than we have been the last year. The economy can turn one way or the other. We're definitely at an inflection point. So watch out for what's going on with the economic data and what's going on in the market. There's going to be a very window of time where the Federal Reserve is going to start making some significant decisions, and I think it's going to be slower than anticipated. So thanks for tuning in today. If you like this video, please hit the like button, subscribe, hit the notification bell. I plan on bringing more market updates to you in the near future as we hear more about the interest rates. And thank you guys all for subscribing recently. I appreciate it very much. See you next time.